Welcome, everybody. My name is Tim Sink. I am president of the Greater Concord Chamber of Commerce, and I want to thank you for taking time to join us for a program that I think you're going to find very, very interesting this morning on economic insights. But before we jump into the program and introduce our speaker, I've got a few announcements I'd like to make. First of all, I just want to do a shout out and a special thanks to our friends at Eversource Energy Services. They have been tremendous supporters of the Chamber of Commerce, and you may or may not know that Eversource plays a very critical role in New Hampshire in terms of promoting economic development. So they are a wonderful partner, and we're very grateful to have them sponsor this event. And I know Allison McLean from Eversource is on the program with us today. So thank you, Allison, and thank you, Eversource. A couple of upcoming events I want you to be aware of. On Thursday, March 4th, we will be hosting our State of the State event. This will be via Zoom with Governor Sununu. So you can find all these events on our website, and you can register for them at your leisure. So please join us on the 4th. I'm sure you're going to enjoy this. This is from 10 to 11 a.m. via Zoom. And then following that, on Thursday, March 11th at 9 o'clock, we are doing our legislative updates, and we've got a great panel. You can see Dave Jubé from the Business and Industry Association, Phil Sletton from New Hampshire Fiscal Policy Institute, and Dean Spiliotis from New Hampshire Political Capital will sit on a panel. This will be facilitated and moderated by Ari Pollack from Gallagher, Callahan, and Cartrell. Ari is the chair of the State Government Affairs Committee. So following that event, coming up on Thursday, March 18th, we have a new event that is scheduled. This is in partnership with the SBA. It is a webinar, and it'll focus on a number of things, but really focus in on PPP loan forgiveness and related issues. So you really want to pay attention to that because you want to maximize your loan forgiveness on PPP. And then the final one I'll just mention to you, you'll be receiving invitations to this shortly, but we will be celebrating virtually our Citizen of the Year celebration. Typically we do an annual meeting, but we're not bringing 400 people together for dinner this time. We're going to do this sort of virtually. It's going to be hosted at the Bank of New Hampshire stage. We'll do a live stream, and there will be a networking event. Prior to that, you're really going to want to sign up for this one because we're using a very interesting software that allows you to do some advanced networking. It's just really cool. So March 30th, and all these events are online at our website. Go to concordnhchamber.com, and on the landing page you can click on any of the events. So just in terms of logistics, we will hear a presentation. You will have an opportunity for Q&A. At the bottom of your screen, you'll see a Q&A icon. You can click on that anytime during the presentation and type in your question. We will hold the questions until the end of the presentation, but we'll get through as many of those as possible. So please feel free to use the Q&A icon in the bottom. And now it is my distinct pleasure to introduce our speaker. Dr. Osborne Jackson is a senior economist at the New England Public Policy Center in the Federal Reserve Bank of Boston Research Department. His research interests include labor economics and urban and regional economics. Dr. Jackson earned his BA in economics from Harvard University, his PhD and MA in economics from the University of Michigan. And before joining the bank in 2015, he was an assistant professor of economics at Northeastern University. Dr. Jackson is a prolific writer. He has published and has pieces on many very interesting subjects, including educational attainment, unemployment and wage inflation, subjects like larceny in the product marketplace. I'm just going to mention a few of these to give you an idea of the breadth of his experience. An approach to predicting regional labor market effects on economic shocks, the COVID-19 pandemic in New England. You may hear a little bit about that today. Punishment and crime, the impact of felony conviction on criminal activity, the impact of migration on earnings inequality. So obviously, we have a very limited speaker today, and we're delighted to have you with us, Dr. Jackson. So the podium is yours.
Thank you very much, Tim. That was a very kind introduction, and I want to thank you and the Greater Concord Chamber of Commerce for inviting me today to speak with everyone. So let me just share my screen and then we can get started. Okay. Well, good morning, everyone. And it's my pleasure to be able to join you all today and give a bit of an outlook on economic conditions in New England recently and over the past year since the pandemic started. Before I get into that, let me just give you a little bit of background on me and on my role within the Federal Reserve System at the Boston Fed. So as some of you or all of you may already be aware, the Federal Reserve System is made up of the Board of Governors and 12 regional Fed banks, including the Boston Fed. And so the research departments in each of those institutions are situated to help support the responsibilities of the Fed, including, but not limited to, monetary policy. And within the Boston Fed's research departments sits the New England Public Policy Center, of which I'm a part. And so our mission at the center is to promote better public policy within the region through research analysis of relevant economic and policy issues. And that spans many topics, many of which Tim just touched on, although those were only mine. I have colleagues that do other interesting work as well. And so those topic areas as of late include the impact of COVID-19, the opioid epidemic, and affordable housing in the region, just to name a few. So with that background, I want to get into talking with all of you about some of the trends we've been seeing in the data regarding economic conditions in New England. And we'll start with employment and in general with the labor market. And so the figure that you're looking at is examining non-farm payroll employment from a representative sample of US businesses. And this is the current employment statistics. And it's indexed to pre-recession peaks after the Great Recession and possibly varying by area. So values above 1 indicate that employment has returned to its pre-recession level. And so what we can see in this figure is that since the start of the current recession, basically, as was the case in Q3, non-agricultural employment in New England continues to rebound from the sizable spring decline. Now 8% below its pre-recession peak and slightly behind the US, which is 6% below peak. I should also add that most of the data I'll be giving discussion of today in the presentation are through the end of 2020. In some cases, it's the beginning of 2021. This is a case where we're looking through the end of 2020. And so when I say now, it kind of refers to the period relevant to a given chart. And so we saw this large decline at the start of the pandemic, 8% below peak for New England and 6% for the US. And New England's rebound since the initial decline is greatly aided by Connecticut, which is 6% below peak, the closest in the region to actually reaching its pre-recession level of employment. Now, in contrast, Massachusetts, New Hampshire, and Rhode Island have experienced more sluggish jobs growth comparatively. And those 3 states are tied for second lowest in the region, all at 9% below pre-recession peak. And Vermont trails in the region at the lowest at 10% below peak. Now we can look a little bit more closely at patterns during the pandemic specifically. This table shows pairs of columns that each reflect employment growth in levels and percentages during the 3 periods of the pandemic. And those periods are initial months, subsequent months, and then the overall pandemic period. So what this table shows us is that we can see more clearly now those large double-digit percentage decreases in jobs growth that happened during the initial months of the pandemic. And so New England experienced an 18% employment decline, while the nation as a whole saw a somewhat smaller, but still very large 15% jobs decline. Now, in subsequent months, April through December, we can see that there's that large rebound that the previous figure illustrated, and accordingly, positive double-digit percentage jobs growth throughout the region that exceeded that of what was experienced in the country as a whole. But in those last set of columns, we can see that overall during the pandemic, employment in the region and in the country still hasn't attained the level seen in February 2020, which is what we saw in the previous figure as well. So still below pre-recession peak. Now, when we look at New Hampshire in particular, New Hampshire experienced an early pandemic decline in jobs growth at 17%. That was basically in line with what was happening in the region as a whole. However, employment growth subsequently at 9% was relatively sluggish in the state, ranking lowest in the region. And overall, during the pandemic, jobs growth in New Hampshire pretty much aligns with what's happening in the region. Now we can continue to focus on jobs growth, but now looking over the past year across different industries of the economy. And so that's what this figure is showing, year-over-year growth from December 2019 through December 2020. And expectedly, all the industries in New England have experienced an employment decline relative to last year. Now, New England industries that have seen the largest declines are expectedly leisure and hospitality, as well as other services. And other services cover things like dry cleaning and laundry, personal care like hair care, and so on. And then government as well. Conversely, the New England industries that saw the smallest declines over this period are finance, professional and business services, which include things like legal and accounting, architecture, consulting, and manufacturing. Now, regarding notable disparities between the region and the US, we can see that this applies to the information industry, which includes things like internet, data telecom, publishing. The information industry suffered relatively less employment decline in New England compared to the country as a whole. And on the flip side, in terms of a notable disparity with the US, leisure, hospitality, other services, and construction all suffered relatively greater declines in New England than what we saw in the country as a whole. So once again, we're focusing on just the pandemic period and examining these industry-specific trends, but now split by two periods, the initial decline and then the subsequent months where we've seen some rebound. So the first thing you'll see here is that the same industries that were previously examined for year-over-year changes also suffered the largest employment declines from February to April of 2020 in that initial period of the pandemic. However, when we look at the smallest declines in the region, now in addition to the finance industry, we see that information and government industries are in this bottom group. So that year-over-year decline that we saw in jobs growth for government in New England seems to be largely driven by a lack of a rebound after the initial decline rather than the initial decline itself. The other pattern that we can see if we're looking at this figure is that the size of the decline from February to April is generally proportional to the size of the rebound from April to December. And we might expect this given the role that local ordinances played in governing what was happening and the extent of activity in some of these industries. And these ordinances were generally issued in the region and much of the country in that initial period and then relaxed in subsequent months. However, as we all know, some of those restrictions were then imposed again as cases were spiking, especially during the summer, during the holidays, and some holidays over the summer as well. So still focusing on the labor market, but moving now from focusing on the payroll survey and jobs growth to looking at unemployment rates, we can look at household survey information from a representative sample of US households, and this is from the current population survey. And we can continue to look at trends during the pandemic and just before the pandemic. So what this plot is showing is that both nationally and also in the region, the share of the labor force that's unemployed has generally continued to decline since the second quarter of the year, sort of after that initial spike. Although some areas like Connecticut, Massachusetts, and Rhode Island have seen a recent uptick in those unemployment rates. In December 2020, in particular, the US was at 6.7% unemployment. And in January 2021, the US was at 6.3% unemployment. New England was at 6.9% unemployment as of December 2020. Now, new data for New England and for local areas aren't going to be available until mid-March. And so that's why we're kind of only examining through December, even though there's national data that is available a bit later. Now, looking at the highest rates in the region in December 2020, Rhode Island was at 8.1% and Connecticut was at 8% unemployment, both above the US unemployment rate. Meanwhile, the lowest rates in the region at that time were New Hampshire at 4% and Vermont at 3.1%. Now, it's not unusual for New Hampshire and Vermont to have low unemployment rates in the region, as this figure shows, and that's generally because those labor markets tend to be tighter, in part because of things regarding migration patterns and also sometimes related to housing costs, and so there just tends to be a relatively low number of job seekers compared to vacancies posted. Now, we can also see that unemployment rates for New Hampshire vary across labor markets, across metropolitan areas in particular. And so before actually we get to that, let me talk about what's happening during the pandemic. So when we look, again, kind of specifically during the pandemic period, we can see that growth in unemployment rates was massive in the US and New England in the initial months. Again, part of this is because of the fact that we're dealing with a very low base of unemployment in February, and because we're seeing, in some cases, historically low unemployment rates. And so these kind of extremely large percentage growth rates are in part driven by that, but also because we saw, in an absolute sense, large increases in the number of people that were unemployed. And it's also worth noting that even those really high numbers are still likely a bit of an underestimate because of some documented measurement challenges that were occurring at that time, especially in areas like Connecticut and Maine, as reported by the Departments of Labor. And so, the Bureau of Labor Statistics came out with some adjusted estimates, but even with those adjustments, we're still seeing estimates of unemployment rates that were not extremely far off from these numbers, but somewhat higher. Now, given a subsequent rebound from April to December of 2020, the net effect over the entire pandemic period is muted, but still sizable. And the lower percentages that we're seeing in that rebound period are conversely due to a relatively high base of unemployment rates in April. So that should be kept in mind. Now, what we can see when we look at the overall pandemic period is that Massachusetts has experienced the largest growth in unemployment, while Vermont, Maine, and New Hampshire have seen the smallest percentage increases in unemployment. For New Hampshire and Vermont, this is true despite that large growth in the initial pandemic period, just worth noting. Okay, now, what I was saying earlier, so now we can also look at unemployment rate patterns within states, focusing on metropolitan areas. And so here it's worth noting that for New Hampshire, we're looking at Dover, Durham, Manchester, and Portsmouth. And so when we look at what's happening within the state, we can see that there are similar unemployment rates for New Hampshire across these metropolitan areas. So in December 2020, unemployment was 4.2% in Dover, Durham, likewise in Manchester, and slightly lower at 4% in Portsmouth. And so what this is telling us is that there's similar unemployment patterns across urban and rural areas of the state, which is not always the case. Sometimes we see fairly disparate patterns within the state across those areas, but that doesn't seem to be the case in New Hampshire. Continuing to look at the labor market, it's of interest to look at labor force participation rates because we might worry that some of those unemployment trends that we were just examining are hiding changes in the labor force that are contributing to the statistics. Keep in mind that the unemployment rate is the number of unemployed as a share of the labor force, which is the employed plus the unemployed. And so if unemployed workers are becoming employed, that drives the unemployment rate down. But it's also the case that if unemployed workers are leaving the labor force, then that also drives the unemployment rate down, which has completely different implications for the economy. And so we want to know which mechanism is driving the patterns in the unemployment rate when we observe it. And so looking at labor force participation helps us get at that a bit, and that this rate is the number of people in the labor force as a share of the civilian non-institutional population that is 16 and over. And so it's the share of the population that's working or actively seeking work. And so the first thing we can see is that there's high labor force participation rates for New Hampshire and Vermont traditionally. And this is also something that contributes to typically low unemployment rates in those states, is that the share of people who could be working tends to be relatively higher in New Hampshire and Vermont compared to some of those other states. And so there's just less slack when things get better in terms of trying to accommodate additional positions for job seekers. Or trying to find additional job seekers for available positions, available vacancies. So that's the first thing. We can also see that the labor force participation rate has indeed fluctuated, especially as of late during the pandemic, which has mitigated some of the changes in unemployment that we would have otherwise seen if there weren't those labor force participation changes. Now, despite that dip and somewhat of a rebound, New Hampshire remains the highest in the region with a labor force participation rate of 66.1%. That said, this is still several percentage points lower than the labor force participation rate that was observed at the start of the pandemic. And that's notable because this is a measure that tends to move quite slowly, as you can see from the figure. And so to have these kind of drastic changes during the pandemic is atypical, but understandable given the circumstances. And when we look at labor force participation rates during the pandemic in particular, this table highlights some of what we saw in the figure. So we can see that the rates have fluctuated during the pandemic, and that New Hampshire was kind of in the middle of the pack in the region in terms of those initial labor force participation rate declines at 8%. And the subsequent increase that the state observed was 4%, also kind of middle of the pack. One other thing you might notice from the table is that the timing in Vermont differs a little bit from the other areas in the region regarding these labor force participation rate changes. But as one can see when looking into the payroll survey data a bit, some of the labor market decline in Vermont preceded the pandemic. And so that likely contributes to this disparate pattern that we're seeing in these kind of small period segments. And it's also important to highlight that overall, when we look at those last two columns, trends are similar in Vermont compared to the rest of the region. Now, turning from household survey information, we can also examine some alternative high-frequency data sources to continue to look at regional conditions during this unique recession. And so the next three slides provide some insight into the output for businesses that might be especially affected by the pandemic. Now, the current figure is looking at year-over-year seated diners at a sample of restaurants on the Open Table network. And it's only states or metropolitan areas with 50+ restaurants on the Open Table network for 2019, 2020, or 2021 that are included in the sample. And Maine and New Hampshire data were added in November, on the 9th of November in 2020. So it's not available for the entire period, but I wanted to make sure to include those. And Vermont data are not currently available as of yet. And so what we can see in this figure are that the data are quite noisy and fluctuate a lot. So it's best not to place too much emphasis on any one data point and focus just on the overall trend. And what the figure is telling us is that some patterns we already observed in the labor market data are also true when we examine these restaurant reservations in terms of what we were seeing for leisure and hospitality. But now, rather than looking at the labor market, we're focusing on the product market and something that's relevant, a factor that's relevant for sales in that industry. And so following that complete shutdown in March, when everything kind of dropped down to 0 or negative 100% here year over year, we can see that reservations started to build until Labor Day weekend in early September, when we see a spike relative to the previous year, especially in Rhode Island. And then year over year growth in reservations started to decline afterwards and was negative in all areas prior to Thanksgiving weekend when there was another spike. And there seems to be an additional positive spike on New Year's Eve. So you can see that there's a holiday effect. And that New Year's Eve spike was 132% year over year in Rhode Island, which is quite large, and positive but not as large in New Hampshire at 46% year over year increases in reservations. Another thing that's worth noting is that we can see that summer growth in reservations trailed in Massachusetts compared to Connecticut and Rhode Island. And growth in Massachusetts largely remained lower than those areas until the winter, when things kind of clustered a bit more, understandably, as restaurants were less open. Turning to the number of small businesses that are open, we can continue to look at some alternative high-frequency data sources to get further insight into the extent of output. And so now we're looking at small businesses, which might be particularly susceptible to the current downturn. And so this figure is looking at the percent change relative to January 2020 in the number of small businesses that are open, and it's a 7-day moving average to smooth things a bit. And so small businesses are defined as those with annual revenue below the Small Business Administration's thresholds, which vary by industry, and reflect the maximum workforce of 100 to 1,500 employees to be considered a small business, depending on the industry. And the definition of open is having had at least one transaction in the previous 3 days. So with those definitions in mind, we can see that in mid-April, small businesses open declined by nearly 45% in the US compared to January 2020. And in New England, this decline tended to be greater, ranging from about 47% in Connecticut to 57% in Maine. Now, following the recovery later in the second quarter of 2020, trends were stable in the third quarter of that year, and then we saw some decline again in the fourth quarter of 2020, including a bit of an end of the year dip, although those patterns occurred to a lesser degree in tighter labor markets like New Hampshire and Vermont, which can be seen to lie above the rest of the states in terms of those trend lines. And New Hampshire and Vermont saw declines that were around 25% compared to nearly 30% decline in the US as a whole. In the rest of New England, however, we saw that those quarter four declines were on the order of 40% in terms of the number of small businesses that were open. Now, so far in the first quarter of 2021, New Hampshire and Vermont seem to be experiencing a slight rebound in the number of small businesses open, but still a decline, while the rest of the region and country seem to be a bit more stagnant and maybe even declining a bit further in terms of small businesses open, that growth rate. Now we can likewise look at the percent change in relative to January 2020 in the revenue for small businesses rather than openings. And this is again a 7-day moving average. So not surprisingly, we're seeing some of the same patterns here for revenue, or at least similar patterns to those that we observe for the number of businesses, with two exceptions. One is that the extent of decline is generally greater in this figure, and that's because a business need not close in order to have a revenue decrease. And also Vermont now is clustered in this figure with the rest of the region rather than with New Hampshire and the US, which kind of separate a bit from the other 4 areas. Okay, so we started with the labor market. We looked into output, and we can kind of continue to examine output, but now focus on the prices of goods and services and how those prices have changed using year-over-year growth in the consumer price index for the US and the region. Now, Boston here, the Boston CPI reflects Boston, Cambridge, Newton metropolitan area in Massachusetts and New Hampshire, and is the closest thing that we have to being able to examine the New England region. Data for the Northeast region are also available, but that covers New York, New Jersey, and Pennsylvania as well. And here we're looking at data through January 2021. So what we can see is that recent inflation in the US and in the region remains below 2%. And in particular, in January 2021, US inflation was at 1.4%, and Boston metro inflation was at 0.5%. Now, those figures, those numbers include food and energy prices, which tend to be more volatile. So I'm going to touch on inflation numbers that exclude those goods, known as core inflation, very shortly. One other thing to note from this figure, which you can see, is that the last time that overall price growth was comparable in the region and the nation was roughly 6 years ago in 2015. Now we can break down those inflation patterns further across various goods and services. Now, in addition to inflation for all items, as I just mentioned, when we omit food and energy items and look at core inflation in January 2021, that core inflation rate was slightly lower in New England and the same in the US. And so thus still below 2% in both cases. Now, compared to the US as a whole, when we look at these components of the CPI, the largest differences in the region regarding price growth are in medical care, recreation, and also fuel and utilities. Okay, so turning now to the housing market, we can start by looking at foreclosures as a percentage of mortgages. And so in addition to telling us about what's happening in the business cycle, these data can also be used as a bit of a partial indication of changes in the supply of housing, which might then have some effect on housing prices. And so compared to the fourth quarter of 2019, when this foreclosure rate was 0.2% in the US and in New England. We can see that New England and the US have decreased by 0.2 percentage points to virtually no foreclosure started in the fourth quarter of 2020. And that's not surprising given the fact that there are moratoriums that have been put in place since the pandemic to try to curtail such foreclosures. Now we can look at how home prices have changed year over year via this repeat sales home price index for the US and the region. And what that means is that we're looking at the price of the same property that's repeated over time. And so these data are from the Federal Housing Finance Agency, which regulates Fannie Mae and Freddie Mac, and they reflect single family home prices from purchases. So this excludes refinance appraisals. And so what we can see here are that housing prices continue to appreciate for New England and the US with a notable increase in the third quarter and the fourth quarter of 2020. And New England recently overtaking the US in the fourth quarter of 2020. So in that fourth quarter, the US housing price growth rate was 10.9%, and that same rate was 12.8% in New England. And for some comparison, in the second quarter of that year, it was 5.7% in the nation, and then 8.0% in the third quarter. In New England, it was 4.7%, and then grew to 8.5% before attaining double digits more recently. And when we look at house price changes, we can kind of further break things down across states. And so, in those first two bars, we're seeing what I just mentioned regarding the year-over-year change for the US and New England at 10.9% and 12.8% respectively. But we can see that patterns differ within New England. And so Connecticut has the highest growth rate at 14.2%, and Massachusetts has the lowest housing price growth rate at 11.4%. Now that latter rate for Massachusetts might be partially driven by a lack of demand that's happening, a very kind of pandemic specific effect, lack of demand for densely populated metropolitan areas like Boston. And so that might be part of why we're seeing housing price growth relatively low in Massachusetts, although still quite high as it is throughout the region. And to further kind of examine that hypothesis, we can look at house price changes in New England, but across different metropolitan areas. And so now we're looking at these within state differences. And these data are specifically from the Federal Home Loan Mortgage Corporation, so Freddie Mac, and exclude the Fannie Mae data. And so as hypothesized, we can see that metropolitan areas like Boston, Cambridge in Massachusetts, Quincy have slightly lower housing price growth than the state as a whole. However, while metropolitan areas like Portland, South Portland, Biddeford, and Maine have somewhat higher housing price growth than the state as a whole. So there is a difference in terms of, in some cases like Massachusetts, those large metropolitan areas seem to be growing more slowly in terms of housing prices, and other areas like in Maine seem to be growing faster, and that might also be driven by kind of differential demand across those states. Now in New Hampshire, Manchester, Nashua, housing price growth was at 13.3%. And that's slightly lower than the state as a whole, which was 13.7%, but basically fairly aligned. And so we're kind of seeing a similar consistency within the state when we look at the housing market and what's happening to prices, as we saw when we looked at unemployment rates. So there's no large urban-rural divide, at least as far as what we're seeing in the data. So just to conclude and kind of take stock of everything that I discussed over the past half hour, labor and product markets suggest that there's an ongoing rebound of the economy, but that recovery is fairly sluggish given continued challenges regarding the COVID-19 pandemic. Core inflation remains below 2%, while home prices are appreciating and to a greater degree in more recent periods. Now, reasonably and expectedly, because uncertainty still lies ahead given the public health situation, there's some degree of a lack of definitive statements that can be made. But even with that uncertainty, consumers in the region have slightly higher expectations for the future than they did 1 year ago. And so, moving forward, as we start to see more data and data that reflect some of the more recent developments regarding the public health situation, we can see how those expectations continue to evolve, and more generally see how the economic situation evolves as the public health situation continues to change, and as policy developments also change regarding measures to try to help sustain individuals and businesses while the pandemic is still ongoing. And that concludes everything that I had. I want to thank you all very much, and I look forward to discussing any questions that everyone has.
Thank you very much, Dr. Jackson. I'd love to kick it off a little bit with a question, and some of this you've already touched on, but could you talk a little bit about, we've seen an influx of folks moving from metropolitan areas to places like New Hampshire. It's driven up the cost of housing quite a bit, and we've been trying to take advantage of this in terms of the biggest issue for businesses in New Hampshire pre-COVID was labor force and talent recruitment. And so now we're kind of seeing an opportunity and a silver lining here that's saying, hey, people are moving out of metropolitan areas. Can we capture them in New Hampshire? They have been coming, but can you talk a little bit about what the economic impacts of that migration could be?
Thank you, Tim. That's a great question. And I mean, I think one thing that could potentially influence came up during the presentation, which is the tightness of the labor market in New Hampshire, and some of those labor market indicators like unemployment rates. I have some work, granted, that was looking prior to the current period, but was looking over 1940 through 2015, and New Hampshire over that period had the lowest immigration rate in the region. It had a high immigration rate, but also had a high out-migration rate. And so there was a lot of churning. And so if some of those patterns are changing during the pandemic in terms of relatively greater inflow of individuals, some of whom will be in the labor market, then that might help in terms of unfilled vacancies that would previously be reflected in terms of very low unemployment rates in the region and a tight labor market, in terms of possibly changing that. So I mean, I think that that's one possible effect of some of those altered flows, migration flows.
Thank you for that. Another question had to do with earlier on in your slides, we saw a larger job decline in New England as compared to the rest of the US. Can you talk about that at all? Why were we seeing greater job decline? One idea that I had was that it's kind of contradictory, but we have manufacturing as our largest driver of the economy, but our second largest is hospitality and tourism. So I don't know if you can talk to that a little bit.
No, I think you touched on exactly one thing that I was going to say, which is that some of those patterns and how they differ across areas. There's different factors that matter for that, but one important factor is just the sectoral composition and how that differs across different areas. And so, for instance, in Massachusetts, education and the medical industry are relatively large, and in other parts of New England, hospitality, as you touched on, is a large component of what drives the economy. And so, this pandemic and the recession that it brought on are so kind of unique in the fact that they're very sector specific, and particular to leisure, hospitality, and kind of related industries, service industries. And so, the places that are seeing or that saw those larger initial declines, and to some extent have seen kind of more sluggish rebound, I think is driven in part by those different sectoral composition patterns, those different sectoral shares in terms of the importance of leisure and hospitality in some areas versus others. So I think that is a driving factor, or at least an important factor for some of those differences in New England compared to other areas, especially given the role of leisure and hospitality in northern New England.
Great, thank you.
No, thank you.
Another question here, can the data provided per industry be used to focus investments by the stats? For example, construction and recreation was behind the national trends. Should state investment be targeted there?
I mean, that's a good question. I mean, I think I'll stay away from, prescribing any particular investment patterns. But I think that, one thing that the data do show, I mean, one caveat is that the data that we look at are retrospective. So by the time that they're released, it's telling us kind of what happened, but it's not necessarily what's going to happen. And so I think from an investment standpoint, for the state, you can kind of see where things have, been kind of the most problematic or the most sluggish, but not necessarily like kind of in real time if things have changed more dramatically. And that's kind of where, the efforts to look at more high frequency data as of late have come from, is to try to kind of keep up with what's happening in closer to real time, given that things, especially in the initial part of the pandemic, were changing very rapidly. So things like those small business patterns and those restaurant reservations, are atypical and not traditional data sources for us, but at least kind of give us a little bit more real-time information. Now that said, we weren't seeing anything dramatically different in those data than what we were seeing in the data that have a bit more of a lag before they're released. And so, I think they are, at least to some degree, informative for state governments in terms of action that they might want to take and where it's sort of most potentially useful in terms of not just businesses, but also in terms of vulnerable populations as well, when we look at differences by demographics. And so I think that there is a good role for the data there to kind of make more informed evidence-based decisions, with the caveat that there is a bit of a lag sometimes between some of these data sources and what's actually happening currently.
Okay, thank you for that. We've got another one just popped up. Was there an observable effect of federal stimulus? Oh, let me get that, I just lost it. Was there an observable effect of federal stimulus programs on the data that was shared during the presentation? That's a very general question, but I think apropos.
I mean, I think so, less so in terms of, what I showed you all today, but as you mentioned, Tim, like one of the things that I looked at prior to the current period, midsummer, was, looking at the impact of a regional shock like the pandemic on the labor market in New England. And, there it was kind of more about projecting forward what might be happening with unemployment rates and other labor market indicators, and kind of trying to see, if we allow for the possibility that the stimulus was, spent entirely and went right back into the economy, like what would that mean in terms of what we would see for labor market effects like unemployment. And so, in that study, what I ultimately found was that, when you look at the effect of the stimulus, it kind of offset, or at least hypothetically offset some of what might be called more indirect effects of the pandemic on the labor market. So, there's kind of these direct effects on people that were, most immediately affected in leisure and hospitality. Basically, the people who weren't able to work remotely and were non-essential and kind of were most directly affected. And then we saw spillover effects into other parts of the economy kind of over time. And so those indirect or spillover effects were smaller, but they existed. And the size of the CARES Act, from what I was seeing in the data, seemed to offset some of those smaller indirect effects, but wasn't kind of doing more beyond that. Now that study, that work, had some assumptions built into it. So I don't want to put too much stock into it in terms of definitively saying, this is what the CARES Act did versus this is what it didn't do. But I think that it was informative to say that the size of that stimulus, was certainly not sufficient to cure the entirety of the effects of the pandemic. And I think that that's not a controversial statement. And I think that as a system, as an organization, one thing that we've been saying and is clear is that there would be a beneficial role for additional similar policy action. So to help kind of stem the tide of the effects of the pandemic while public health actions are being taken to try to get us out of the current situation. And I think that still holds true.
Thank you. This is kind of a very general question here, but we have been pumping a tremendous amount of money into the economy. The stimulus packages have been, in my opinion, just the numbers are just huge. They're hard to get my mind around, and they've had, as you answered that last question, they've had an effect. But can you give your opinion on what the long-term impacts of this stimulus spending will have on our economy? I mean, it's provided some benefit in the short term, but what are you seeing in the long term?
It's a tough question. It's a very appropriate question. Unfortunately, it's a tough question, particularly now. And so, I mean, I think that we do try to not just look retrospectively, but forecast forward about some things. I think that the challenge now with this particular recession is that it's so directly and intimately tied to the public health situation, and there's so much uncertainty that still lies ahead, even with the recent developments regarding vaccinations, about the timing and kind of the exact evolution of that situation, that it becomes more challenging to kind of predict forward, especially in the long term, whether it's about the stimulus or any other kind of aspect of the economy. So I mean, I think the only thing that I'll say is that there seems to be indication that such policy action has benefits, and so whether or not those actually translate into long-term benefits and the nature of those long-term benefits, I think is more difficult to say. But certainly there are short-term benefits, and I think at the moment, given some of the very kind of crucial short-term needs, it's not necessarily as short-sighted perhaps as it would normally be to kind of focus on that near-term effect, in part because the longer-term effect is relatively harder to examine right now than it would be even in normal times.
Thank you. Another question here, given the rise in the consumer price index and an inflationary trend of 2%, it does seem that the cost of food and its distribution is outrunning those rates. Knowing the recent trade discussions and international relations, do you see the future prices of food increasing over the next 2 quarters and into long-term commodity pricing?
That is also, I feel badly kind of giving the same answer in terms of forecasting difficulties, but I mean, I think that it kind of falls into the same bin as my response to you, Tim, which is that it's a bit hard to say. I mean, I think that we've seen so many developments regarding that particular set of products, just because how people are consuming food now is very different, as we saw in those restaurant reservations. Dining out has changed dramatically. The delivery system by which people are getting their groceries has changed for many. So I think that some of those things are still ongoing developments, and so it makes it a little bit harder to try to project forward regarding what's going to be happening with those prices. And yeah, I mean, I think that's probably the most that I can say, other than that. It's perhaps not surprising that we're seeing prices elevated in that area. Whether or not it continues going into the next 2 quarters as the person inquired, I can't say for certain.
Thank you. This has been great information. I really appreciate your presentation, Dr. Jackson. If we were here, we'd give you an applause, but that doesn't work in Zoom presentation mode. Oh, let's talk about one final question if you've got time for it.
Sure, absolutely.
Okay, here we go. Studies show that women are disproportionately leaving the workforce due to COVID. Do you have any data that shows the impact of this in New Hampshire, both now and 5 years from now? How can employers support their return? There's a crystal ball question for you.
No, I mean, I should add that all the crystal ball questions are perfectly reasonable questions. I think it's just my crystal ball is not as good as I think it would ideally be. But yes, I mean, I think that I can say that in general we have seen that the pandemic, the current recession, has kind of disproportionately led to exit from the labor force of women, especially those with young children, because of childcare needs. I haven't looked at that for New Hampshire in particular to be able to say for certain, whether or not that effect is differentially larger in the state compared to the region or the country as a whole. I think it would be interesting to see. I mean, what I can say is that, if it's, I mean, that would kind of depend on demographics. So, depending on the nature of, the labor force in New Hampshire, and the share of women that are not only in the labor force but with young children, and then single versus partnered households, and how those childcare responsibilities are kind of shared, then that would probably drive differential patterns for the state compared to what we would be seeing in the rest of the region or in the country as a whole. So that's just kind of a general framework by which one would want to go into looking into that. But not having looked at that specifically, I can't speculate as to what the differential pattern would be, and at least in what we've seen recently. Looking forward 5 years, that's harder to project. I mean, I think how permanent some of these departures from the labor force end up being is an open question. In some cases, it's purely driven by these childcare responsibilities, and then it might be that people are able to return again once things kind of return to normalcy or something closer to that. But to the extent that it's reflecting things that actually don't kind of bounce back, if people maybe make more permanent arrangements regarding what's happening in the household regarding work decisions versus stay-at-home decisions, and some of those changes might end up not reverting back to what we were seeing before once things kind of get back to normal. But I think that's just me kind of speaking of it more generally. I think we'd have to first look at the data for New Hampshire to see if their patterns are differential in the state compared to the rest of the region or the country, and then look a little bit more at factors that might be important for that long-term effect, or else just kind of wait to see how things evolve a little bit with more time before we can get a better sense of what would happen in the long run and if things would revert. But I think there are some patterns that we've been thinking about and that economists have been looking at that won't necessarily go back to normal, because there are things that are changing in some of these industries regarding the nature of how output is being produced, labor versus capital, versus, automation effects, and things that are likely going to be permanent. Some of these changes regarding the share of people that are working from home versus working in a brick and mortar location, that might not revert back to what we were seeing before. So I think it's a fair question to ask about the permanence of some of these effects. Regarding that one in particular, I think I have to look into it a little bit more to be able to answer definitively.
Well, thank you for that answer, and thank you for sharing your expertise and sharing your opinions with us. That's very, very helpful. Great presentation. Really appreciate you being with us here today, Dr. Jackson.
Thank you very much, Sam. It was my pleasure, and thank you for the invitation. I hope everyone has a great rest of the day, and thank you, Emily, as well, for all her help regarding getting me set up and making sure I didn't make any gross Zoom issues regarding technical difficulties during the presentation. So thank you both.
Very grateful to Emily as well. So thank you. And thank you, Eversource, for sponsoring this event. And thank you all for being with us. And please check out our website for future events. Have a great day, everybody.